And so back again, and it feels awkward. And so the idea is I'm trying to learn. I'm trying to, yeah. But anyways, I'll just do it, whatever. And so what I'm planning to do is to answer these discussion questions. Yeah. To prove whether I really understand, yeah, what I just read. And so let's begin. And so what is the entity concept? And apply the concept to partnership. Wow, this will be a long video and I'm sure nobody will watch this. So, well, the entity concept is a concept in accounting where you assume, is that the right uh, where you assume, no, you not assume. You put separate economic entities, are you, well, basically you account them differently, is what I would say. Like, you cannot account for three businesses on the same um, under one accounting activity. I'm not sure. Yep, I suck. A dump. And so yeah, I guess that's the accounting concept, I think. So a bit of a recap. No, not a recap. I'll clarify my answer. And so the entity concept is where you account for economic entities separately. So it says here to apply the concept to partnership. So you account yep, at the first question, and I'm starting to break. So if I apply this to partnerships, let's just go back here. What is the entity concept? Accounting is an organization or a section of an organization. Simply put, the transactions of different entities should not be accounted for together. Each entity should be evaluated separately. And so, if I will apply this to partnership, then that means you should account for each businesses separately, and then I don't know, compare the results. And so yeah, number one, wrong. 5 out of 5 score is 2/5. And so next question, what is the periodicity concept and why is it important for business entities to provide periodic information? What is the periodicity concept? Why is it important for business? Let's focus on the first question. So what is the periodicity concept? And so periodicity concept is where you provide financial information in periods where you present or you account for things or you present financial information monthly, or you do it uh, annually or semi-annual. Sakto ba? But yeah, that's it, I think. So yeah, you provide accounting information. No, accounting information is too broad. You provide financial information periodically, I guess, periodically, in which you divide it. An example would be annually, monthly, quarterly, that kind of stuff. And so, why is it important for business entities to provide periodic information? I read this, so I should remember it. So, it is important for business entities to provide periodic information for its uniformity, I think. Uniformity and so why is it important for business entities to provide periodic information? So it is important to provide periodic information so that let me think, so that businesses can so that there will be a time schedule for financial information, right? And the businesses can, there will be a uniform time where information is ready and the decision makers have to gather in one place to make a decision. Yeah, so there should be a period for that. And that is why it is important for business entities to provide periodic information. And so, yep. Number 2, wrong again. And so, what is meant by the concept of stable monetary unit? Is this assumption realistic? Why is it used in accounting? So let's focus on the first question mark first. What is meant by the concept of stable monetary unit? And so the concept of stable monetary unit is easy to understand. I guess this concept is easy to understand, where accountants or people should when accounting should only use one stable monetary unit. Like, for example, if you accounted for peso, then it should be peso all throughout. You won't change it to dollar or some other monetary unit. And so yep, you should only have one stable monetary unit for your financial statement. And so let's see, next is this assumption realistic? So is this assumption realistic? Well, yes, this assumption is realistic because I think it makes sense that you only use one monetary unit, because using many monetary units would mess up the calculation of the accurate amount of money. So yep. And so why is it used in accounting? I guess why is it used in accounting? It's easy to say, but I'm not really sure why is it used in accounting. It just, it's one of those times that you just say, nah, isn't that isn't that how it should be? So yeah, why is it used in accounting? It is used in accounting because that is how it should be, Joe. It is used in accounting because there needs, what I said earlier. If you had many monetary units in when accounting, you will mess up the calculation, or you would not get the accurate amount of money. Now, because there will be, you will need to convert it again and again and again to make it understandable. So, yep, it would be just easier if you only used a stable monetary unit. So, yeah. And so the next question is, discuss the criteria for general acceptance of an accounting principle. So, discuss the criteria for general acceptance of an accounting principle. So criteria for general acceptance of an accounting principle. So I think there were three criteria for general acceptance of an accounting principle. First is that it should be relative. Then, wait first. No reading. It should be relative, and it should be objective, and it should be feasible. And so, discuss the criteria. So, the accounting principle should be relevant in the way that the principle directly affects the business, or it is useful, and it is useful, and that it is shown that this accounting principle will really help the business in accounting for accuracy or whatever. And then the other one is objectivity, because that the accounting principle can be able to provide, can be measured, I think, measured and be judged reliably. There will be no biases. So yeah, the accounting, the principle is not biased. Yeah. And the last one is feasibility, where it is it is feasible, that it is realistic to apply this principle, and that it is not too costly for businesses. Or I think then let's review if I am correct, or if at least I was close. Criteria for general acceptance. Yep. it was there at least. And so next is, what does the term generally accepted accounting principles mean? So what does the term generally accepted principles mean? So how to explain this? This means that what does the term generally accepted accounting principles mean? Generally accepted accounting principles, in my understanding, so this is not 100% sure accounting, this is just what I understand. Generally accepted accounting principles are the principles that are, followed by accountants in the Philippines or around the world, because it didn't say which general accepted accounting principles. I'm just assuming that it's generally accepted around the world. So yep. And there are I don't know. I'm not sure about what I'm talking about, so I'm just gonna shut up. But basically that's it, yeah. So generally accepted accounting principles are principles that are being followed and accepted by accountants all over the world, or all over accountants in a certain place, and that they agree that this principle is relevant or useful in determining the accurate amount. Okay. So I guess that's that. Probably wrong as well. And so, what is the objective of financial statements? The objective of financial statements is to, of course, account for the business, provide relevant information, and for the the main parties that are interested in it. So yep, financial the objective of financial statements is to benefit benefit the primary users of it, which are the owners of the business and other people who need to use those financial statements. So yeah, that is the objective of financial statements. So it provides accurate data about the business's financial state, and the primary users of those financial statements use those data, the financial information, to make economic decisions to either improve the business or for their own goals or whatever. I think so. Yeah, that is the objective of financial statements, in my opinion. And so, what is meant by stewardship of management? And so I've read this as well just now. And so here it is. The stewardship of management is where the people who manages these financial information, these financial information of businesses are very delicate data. They are very important for the business. And so stewardship of management is basically where the accountant or the person who manages the accounting of a business does his job properly. So he or she is able to provide proper accounting for those who need it. So that's it, the stewardship of management, my opinion. So what makes financial information useful? What is the significance of each? So what makes financial information useful? And what is the significance of each? What makes financial information useful? Financial information allows the parties who are interested in the financial information to make economic decisions. And actually, I'm not sure if there are specific answers for this. I'm just, in my opinion. So, yep, that's already wrong in the exam. But yeah. So that's it. What makes financial information useful? That's it. It allows the primary users to make economic decisions. And what else? To provide information about the financial state of the business, which is like the business's health or how it's doing. And I guess that's it. So what is the significance of each? So allowing the decision makers to have financial information allows them to make economic decisions and therefore improve the business or make economic decisions that are for the good of the world. Yeah. And for the other one, which is to show the financial state of the business or how the business is doing. So yeah, it's significant in that way. I just said it. So yep, that's it. And so I think that's it. That's how I understand the question. So confirmatory and predicative rules are the principal ingredients of relevance discussed. And so I'm not really sure. I feel like I skipped this part when I was reading. So confirmatory and predictive rules are the principal ingredients of relevance. Time to look back. So okay. So confirmatory value is when financial information provides feedback about previous evaluations, and then predicative value is when it can be used as an input process employed by users to predict future outcomes. Okay. So I guess in relevance is so a financial statement is confirmatory when it can be compared to previous, like the financial information can communicate with previous financial information. And predicative roles is when you can use that, you can use that financial information or financial statement to predict what's going to happen with the business. So, yep. And with that, your financial information is relevant. What I'm talking about. And so, next question is, what is materiality? And so, materiality is when, the way I understand it is being able, the weight of the item, or oops, people are still awake. And what is, yep, that's it. So materiality is where, like, if I can explain it, that means I don't really understand, right? And so yeah, that means I don't really understand materiality that well. And so I guess the best way to explain it is in my words. So materiality is when whether this information is relevant or not. So yeah, if that information is important, so it is material, and if it is not important, then it is immaterial. So you're fine, immaterial, which means you're fine even if that information is not included in the financial statements. Yep, that's how I see it. And so, freedom from error means perfectly accurate in all respects. React. So, freedom from error means perfectly accurate in all respects. Freedom from error means perfectly accurate in all respects. I mean, you know what they say, guys? Nothing is perfect. And so, yeah, I don't think that. Well, this is my reaction. So, freedom from error doesn't really necessarily means perfectly accurate in all respects. No, so freedom from error means as it could mean that you did everything right, you did everything, you followed everything. It's just that it is not perfect. Like when you're the way you accounted for the things important is free from error. However, um, you weren't able to account for everything. So you were free from error, but it's not perfectly accurate. So yep, I guess that's my reaction. So yeah, you did everything right, but that doesn't mean that everything is perfect. you may have done everything right, but there may be things that you haven't included. So that's it. And so, yep, that's my reaction. So, what are the enhancing qualitative characteristics? So, the enhancing qualitative characteristics. I think I can remember them all. There were 4. I think that's timeliness, verifiability, comparability, wait, timeliness, comparability, verifiability, reliability. Okay, that's it. Material. No, there is not 4. There's more. There's actually a lot. No, I was right. So the question was enhancing. So yeah, there were only 4. But the 4 were comparability, verifiability, timeliness, and understandability. So I was wrong on 1. So yep, basically that was it. And so what are the enhancing qualitative? Yep, and then discuss briefly. And so understandability is where people your financial statements could be easily understood, like it's not so difficult to understand, and I'm just proof that I didn't read. And so yeah, and then the understandability of verifiability is where your financial statements can be verified. These are enhancing qualitative characteristics. So yep, where you have proof of what are there in your financial statements. And what would I say? Understandability, verifiability, timeliness. So the earlier the better. So your financial statements are too late, and because the longer it takes, the lesser the usefulness of that information will be. And then comparability. I think I already said that. But comparability is where you can compare your financial statements to other financial statements. So yep. So in order for businesses to collaborate and stuff, again, my opinion. And so where was I? Number 13. Oh, almost. So to make financial information understandable for as many users as possible, accountants should present simple, abbreviated, uncomplicated financial statements. What is your view on this statement? So to make financial information understandable for as many users as possible, accountants should present simple. Yes, accountants should present simple, abbreviated, uncomplicated financial statements, because accountants aren't doing this for the accountants. The accountants are doing this for other people. So it is a service job, is my view. So yeah, respect on the accountants. So whatever their opinion is, now their opinions have more weight, in my opinion. So yep. So The next one is, what are the criteria for recognition of the elements of financial statements? What are the criteria for recognition of the elements? I think it was just the same with the recognition for accounting principles. It was relevance, objectivity, and feasibility. And let's see. Yeah, no. Oh, no, I was wrong. It should be probable, and it should be reliable. It has reliability. Nope, it's not reliable. It should be that it can be measured with reliability. So the what was that question again? The criteria for recognition of the elements of financial statements are that it is probable that the elements be able to show relevance, and that it is probable that it can provide economic benefit for the business, the entity. And sige na. And that it can be measured reliably. So yeah, you can measure the cost, or how much is it, and yeah. And differentiate briefly financial concept from physical concept of capital. Oof. So financial concept is where I'm not really sure. I'm sure that I'm wrong. But the financial concept of capital is where you look at the financial side of the capital, where at the end of the period, so you should see that the profit, the net asset, the net asset of the business should exceed the net capacity. I was wrong. Your capital, the net capital, the net asset should exceed the amount of the capital. So yeah, that is the financial concept. And then the physical concept is where your net capital is I just so your net capital should I'm not sure. There I talked about your products being more. It improves over time. So yeah, I'm just gonna get it wrong on this one. And so differentiate briefly financial concept. No, I'm done with that. What are accounting standards? So these are standards in accounting that are followed by accountants. These are like guidelines on how to account for certain accounting stuff. And so yeah, that's it. And differentiate between IFRS and IAS. So the International Financial Reporting Standards are these are the standards that should be followed by people who are entities that are wait these are the standards that should be followed for businesses that do things globally on a global scale. Okay, so these are standards that should be followed if you want to compare information internationally. So yep, this is the standard all over the world, that this is the uniform standards. And then the international, it's, I think I'm wrong both. Sorry, it's wrong. Gosh, shame on me. And so the IFRS is the new one, newer version of the IAS. So yeah, that's it. So what used to be the International Accounting Standards Council or Board, IASC, or the International Accounting Standards Council, is now the International Financial Reporting Standards Council. So yeah, I may be wrong. So yeah. And anyway, that's it. I finished the discussion questions. I'm not sure if I should already go to bed or what. But so yeah, this is what happened. And so that's it.